welcome to another episode of Commodity Masterclass, an initiative by ICICI Direct. And today I have with me a very special guest, Ms. Rashmi Nihalani, AVP Product Management Team, Base Metal Multi-Commodity Exchange of India, MCX. Welcome, Rashmi.
Thank you, Geetu. It's a pleasure to be, at this forum to talk about commodities and specifically base metals, which I'm going to speak about today.
Thank you for being with us. Let's talk about the base metal. If I'm an individual or a corporate in India and I really want to trade in base metal and hedge my position as a corporate, how do I do so?
So, there are two sets of people who can actually get into base metals on MCX. So I'm going to just break it down into two sets of classes. So one is the retail investor. So if you have a view on metals, whether it's copper, aluminium, lead, nickel, zinc, these are the ones that we trade on MCX. So, you create a view in terms of where you think the prices of these metals would be going, okay? And then you can come in as a retail investor. It also really helps because there are a whole host of people who are involved, retail investors who are involved in equity markets. So, if there is somebody who wants to buy, is probably bullish on, say, a Hindustan Zinc strip. And, at the end of the day, the underlying commodity with Hindustan Zinc is zinc, right? So if you are looking at probably buying Hindustan Zinc, which would be a combination of, the management, how zinc prices have performed, how the sectoral performance has been, that's the view you will build up. What you could also then look at is that if the performance of zinc or the price of zinc have been moving in a certain direction, so rather than taking a call on the underlying equity, you come to the commodity exchange and you actually do a direct trading in zinc. Obviously, if you're a retail investor, you will definitely have to go via a broker. So you will, have a KYC done with a broking institution. For example, if they come via an ICICI Securities. So they do the KYC. It's very simple methodology. What you follow in equity, open your account, and you can actually begin trading. And having said that, I think it's important that when you are having a certain amount of asset allocation across various assets, commodities should be an important, asset in your entire portfolio. And, base metals it makes a lot of sense because the value of metals is on a smaller side. Your investment is going to be lesser as compared to some of the larger investments you would make in equity market because, the margins are anywhere between 8 to 10%. So paying an initial margin of 8 to 10% with, the mark-to-market margin or variation margin, what we call in, coming in additionally, you can actually begin a retail person can actually begin his or her, trading in the non-ferrous metals or base metals as we call it. The second class, the second segment that would actually come into base metals market are corporates who have the underlying exposure to that metal. So if you have an underlying exposure in copper or aluminium, you could be a wire maker, you could be a transformer maker, you could be an importer of nickel, you could actually be in the lead battery segment, or from the producer side, you're actually a producer of metal. Between both the sides, whether you're a producer or a consumer of metal, you do have an underlying exposure to that metal. And metal prices over the last, I would say at least a decade and a half have been fairly volatile. Raw material prices have been fluctuating. So, it becomes very difficult for anybody who has an underlying exposure to metals to be able to secure raw materials, on a steady basis at fixed cost. Okay, because there is probably an annualized volatility of anywhere between 18% to 24% across aluminium, lead, nickel, zinc, and copper. So, when you have this much amount of volatility, where an annualized volatility is anywhere between 18 to 24%, you do not really have the business margins to be able to handle the impact of that volatility. So whether you are a producer of metals or whether you're a consumer of metals or you're the distributor or a trader of metal, if you have underlying exposure to metals, then you can use the commodity exchange, the base metal futures contracts that run on commodity exchange to manage your price risk and secure yourself against volatility. So you lock in your price, okay, and you can go ahead and actually secure yourself against any of the volatility that comes in the metals.
Rashmi, how does price discovery really happen on multi-commodity
On
exchanges?
so
Like,
I sorry,
yeah,
yeah.
yeah,
So, here, I just want to add a little bit of a history to the MCX contracts, and then I will, come to what's really been happening now. So, when we launched these contracts were cash settle contracts or both options contracts as we call. The deliveries did not take place. We would settle these contracts on the London Metal Exchange prices. Now, LME, as quote unquote, is considered the mecca of the entire non-ferrous metals price discovery and trading. And we had a licensing pack for them to be able to use their cash settle price, which comes out on a daily basis. So, end of the month, we could use the CSP to settle our contracts, and hence no deliveries really happened. Now, about a year and a half ago, or I would say actually 2 years ago, somewhere around 2018 is when, once SEBI took over as a regulator for commodity markets in 2015. Somewhere in 2018 is when SEBI gave us a directive that it's high time that we start looking at, getting these contracts on the exchange delivered, making it more relevant for the Indian audiences, so that you can have a more India price benchmark. And hence, we converted these cash settle contracts to, delivery-based contracts from March of 2019, starting with aluminum. And then we moved on to zinc and nickel and lead and copper. So by July 2019, we had converted all our contracts to delivery-based. Now, in the delivery-based contracts, what really happened is that because we had, we kept Maharashtra as a primary delivery center. And for lead, we kept Chennai as a primary delivery center, with additional delivery coming in at Maharashtra also. These contracts became an ex-warehouse price. Okay, so what happens is that the price discovery would work in such a fashion that all expenses required to be able to deposit metal at the Bhiwandi or the Thane warehouse that we have. So the price component would basically include everything. So it would be your international price. You'll add the premium to it. You'll add the USD INR conversion. Then you put the import duties, and then the rest of the transportation costs, etc. So your price component today includes all of this, and hence it becomes the price discovery today is more an India price benchmark price discovery, if I could say that. And if you were to actually take delivery of the metal, then you will additionally add GST of 18% to it. So the price is all inclusive except 18% GST, which comes into play if you were to do the actual, to actually buy and sell, pick the delivery from the exchange warehouse. So this is how the price discovery for the base metals on MCX today happens.
If we say that corporates and retail individuals are coming to MCX to trade in metals, how do they manage to hedge their risk exposure? Because
Right.
basic trading on exchange of metal is basically risk management.
Sorry, Gitu, I just, your voice is a little faint towards the end, so sorry.
My question is, like, if a retail investor really wants to come and hedge their position, basically the trading on metal exchanges and exchanges is basically an hedging instrument and not a speculative instrument. Speculation is part of every market, be it equity or be it commodity.
Right.
How do one hedge one's risk if he or she is trading in the commodity?
Right. So, in current set of scheme that you have, there are only two things that you will do. You'll either buy or you will sell, right? So, so there are two sets of people, the corporates who would have the underlying exposure. Okay. So there would be one set of people who have already committed or sold to whoever they were, they are in any kind of, dealing with. So let me just give you an example of it. Let's say that, there is, a company that is, manufacturing aerospace structures, okay, and their regular requirement is aluminum. Okay, so the raw material to manufacture, the aerospace structure is aluminum. Now, when you require aluminum on a regular basis, okay, to be able to manufacture these aerospace structures, you need to have a planned kind of production to be able to procure it and then keep making those components and selling it to whichever airline or aircraft corporation that they are in a deal with. So typically what happens is that uh, let's say if they want to buy say 50 metric tons uh, totally in a month's time or in a month and a half time is their total exposure, and every week they need 10 metric tons of aluminum. So what will they really come on MCX and do? So the moment they get this order from an aircraft company to supply the aerospace structure, and they need aluminum to on a regular basis for this. The 50 metric tons, they will actually split it week on week. So the first week, they will go ahead, buy 10 metric tons at whatever is the prevailing price of aluminum. Let's say it's 165 rupees per kg. So they will go ahead, buy it at 165 rupees per kg. They will go use it in their shop floor and, go ahead and, prepare the aerospace structure that they needed to prepare. Now, the next 40 tons, obviously, they have no idea that over the next 4 weeks, how are the prices for aluminum going to change for this next 40 tons of requirement that they really have. So what do they come is, they'll come on MCX and they will buy 40 metric tons, as a whole on MCX, full 40 metric tons. They will create a buy position on MCX, okay? And every week when they will go and purchase 10 metric tons from the physical market, they will keep selling that much amount of quantity from MCX. Okay. So let me just reiterate. So they go first week, they will go ahead and buy 10 metric tons of aluminum that they require, use it in their shop floor. But for the next 4 weeks, that 40 metric tons needs to be bought at 10 metric tons individually every week. What will they do? They will come to MCX, buy 40 metric tons on MCX at a certain price. Okay, let's say at that point in time the price is 65 rupees a kg. So they will come to MCX, buy 40 metric tons at 165. Now the next week, which is 19th March, okay, they need 10 metric tons more for their shop floor. So they will go buy from their regular vendor. They'll buy 10 metric tons. At that point in time, the price is say 168. So they will come to MCX. Okay, they will buy this, put it on their shop floor, and they will sell 10 metric tons on MCX. They go to the next week, which is 26th March. They again go buy 10 metric tons. At that point in time, the price is 161. They come to MCX and they square off another 10 metric tons. 2nd April, which is the week after that, they do the same thing. They go buy 10 metric tons at 163, come to MCX, sell off 10 metric tons. And then finally on 9th April, when the last tranche is to be bought, they'll buy it at 162, use it on their shop floor and sell an equivalent amount with 10 metric tons at, the same price. Now in this, what they do is, every week they're buying 10 metric tons from the physical market, squaring off their position on MCX. So they will either be making a profit, in terms of, I wouldn't use the word profit, but maybe they're buying it cheaper in the physical market, and hence, they're probably losing a little money on MCX. They are buying it more expensive in the physical market, but they are making money on the MCX position that they hold. So they are offsetting all their losses in physical market with futures, or they are offsetting whatever loss that they have made in futures market with their positions in the physical market. And hence, when at the end of their entire 50 metric ton cycle, the 5-week cycle, when it's complete, they will realize that finally the price that they wanted, which is 165 rupees per kg, was the perfect price for them. They managed to lock in their aluminum price at 165 per kg. So what happens is that the volatility that came in for 5 weeks in aluminum purchases, when prices went from 165 to 168, came back to 61, went to 63, they were safeguarded against any of this, and they were able to lock in the price of aluminum at 165. Okay. So in such a structure, there are various permutations and combinations that one can actually use to be able to to hedge themselves against any price risk. Now, my one very important message that I would want to give to the corporates is that use a commodity exchange only to hedge your prices. Please do not use it for any speculative activity, because a perfect hedge is when you're able to offset your physical market positions against your futures market positions. The moment you get in with the thought process that I'm going to be using futures market purely from a profit perspective, okay, it just becomes, a more speculative trade than a hedged or a price risk managed trade, okay. And that is where you cross the line between hedging and speculating. And in all likelihood, you might end up, making a loss or a larger loss in your position, which you will have to then carry it in your company books. Okay, assuming you would want to get into a speculative trade, create a separate account, do it individually, but do not mix it with any of your, company businesses. Keep that a very clean, purely hedged position. And a quick here is that now, the last 2 or 3 years ago, there was an amendment in the Income Tax Act, which is called Section 43(5), where any corporate who would like to hedge, a position in the commodity market can get an offset for his profit or loss against their physical position. So that also, helps in terms of the hedge accounting.
Let's talk about the India price benchmark. You have recently launched a metal index. How is trading on a metal index beneficial for retail as well as the corporate?
Right. So as far as India price benchmark is concerned, Geetu, there are two things here. Okay. One is the India price benchmark we want to create for the Indian brands. Okay. So so we have started work towards that any which way by moving from a cash settled contract to a delivery based contract, where we would want a lot of the Indian, I would say, demand supply factors coming into play, rather than we being more dependent on what's happening globally. Obviously, commodity markets are such that are not, especially the non-agri segment. You cannot move away from the global headwinds or tailwinds that would come in terms of the pricing. Having said that, base metals, what we have done in India right now is trying to move away from dependency of an international price benchmark, and create a more India price benchmark by making it into a deliverable contract, deliverable in the Indian market, as in, our warehouses, like I told you, are in Chennai and Maharashtra. So that takes care of one part of the entire story in terms of, creating an India price discovery. Now, currently, all the brands that we accept on MCX are LME approved brands. Okay, we do not have any Indian brands right now. We only accept LME approved brands. So LME on its website has a list of brands which it accepts. And hence, anybody who would want to deliver on the exchange warehouse today, or anybody who will pick up metal on exchange from exchange warehouse, would essentially have to have, the seller will have to give us an LME approved brand, and the buyer will get an LME approved brand. Now, in this, what happens is we do not test the metal. The metal that we accept, the LME approved brand that we accept, comes in with a lot of documentation. The certificate of origin, the certificate of analysis, packing, it has to be in an original LME packing form. If it's imported, then customs documents. Any of these documents, if they are missing, and these are all laid out in a circular in a lot of detail. So any documents missing, the warehouse service provider will reject your metal. So currently, everything acceptable on the exchange is the LME approved brand, and some of the Indian brands are also LME approved. Having said that, we got a lot of feedback from the market. For every metal, we have a product advisory committee. So they told us that it's important that when you're doing this and you're accepting LME approved brands, you should also look at Indian brands to be able to get a chance to deliver on the exchange, platform, which we thought is very much in line, quote unquote, with the Atmanirbhar Bharat mission that we're on. So what we did is we did a lot of research, and we found out that the Indian lead industry, the secondary lead industry, is almost 10 times the primary industry. Okay, and they actually use a lot of scrap, battery scrap, refine it and bring it to a very high purity grade of lead. And then this is then sold in Indian markets and sold to battery manufacturers or alloy makers, etc., etc. So what we did is we decided that we should give a chance to the Indian secondary lead industry to be able to deliver on exchange, and hence we created a chemistry of 99.98% purity. We consulted a lot of people within the industry to find out that what would suit at least 90% of the lead industry or the lead manufacturing side, and 99.98% purity with 17 impurities which are capped to a certain level is a chemistry that we created. And we floated a document on the exchange website saying that if you would want to deliver your brand on the exchange, the Indian lead refiners, if you want to deliver your brand on the exchange, this is the eligibility criteria. There'll be a lot of technical audits and a lot of tests that we will conduct in conjunction with a whole host of other entities that we will empanel, and we will then empanel your brand and give you a chance to be able to deliver on the exchange. So this is where we are wanting to create an India price benchmark and also allow the Indian industry to be able to deliver their brands on the exchange. So the endeavor first has begun with lead because it lends itself very well. And going forward, we will also start looking at the other metals once this entire exercise comes to a conclusion and we are able to enlist some brands. So that work, of course, is on. When you talk about the metal dex, when you said about metal index, so metal dex is a composition of 5 metals, which is aluminum, lead, nickel, zinc, and copper. And this index is basically is created with the weightages given as 3/4 to the liquidity on the exchange and 1/4 to the production that you have within the country. And it's an index which is an excellent platform for hedgers who would have exposure to multiple metals, and hence they can take a sectoral view and then be able to manage to hedge their positions. That's one. And two, it's going to be a great product from the institutional perspective, where you have hedge funds and institutions which are now looking to enter the commodity markets, since SEBI has given permissions to mutual funds and bank securities to enter these markets. So great product for them, because then instead of looking at one single metal, they get to have a sectoral understanding of how these 5 base metals will perform. And hence, this is also going to be, I would say, a price benchmarking of a combination of 5 base metals.
Thank you, Rashmi, for being with us. It was a pleasure speaking with you and deep insight into how metal trading happens on metal commodity exchange.
Right. Okay. Thank you. Thank you, Geetu. Thank you so much. Bye-bye.